Hi, everyone, and thank you for joining us for this episode of the Supply Chain Disrupted series. This episode will talk about digitalization, which is a very hot topic impacting every industry. And I'm lucky enough to be joined by two of my colleagues, Ben Algrove, who's a partner based in London in the IP tech practice, and Eric Christensen, our tax partner based in San Francisco. And I'm Moish Razi, a principal economist based in Palo Alto. So let's just get into the discussion. So Ben, I'll start with you. There's a lot of discussion about digitalization, and Baker McKenzie has an entire service line dedicated to digitalization. Maybe you can start us off by telling us why is this such a hot topic, and why is it top of mind for companies, regardless of which industry they're in?
I think I'd start with saying that the temperature or the hotness of this topic probably depends on your perspective and what industry you're coming from. So, digitalization or digital transformation isn't actually something that's that new. It's been in progress for decades, and it has followed the improvement in both technology capabilities but also communications capabilities as well. And so, as the technical infrastructure that supports digitalization has improved and become more accessible, you've seen it move through industries, obviously starting with the technology in the TMT industry, moving into financial services, health and life sciences, consumer goods, and now into professional services and the industrial space and manufacturing space as well. Yes, it is a hot topic. Yes, it's on every C-suite's agenda as to where the corporate strategy fits on the digital agenda. But it's actually something that is, present and has been present for years in various levels. What's changing now, in my view, is the pace of change. So what we're seeing is an increasingly fast pace of change as the cost and barriers to entry come down, as the benefits of data-enabled decision-making and digital flows and digital transactional capabilities start to become obvious and apparent. And obviously, as people are adopting those technologies, you get the competitive pressure, which is if your competitors are doing this, you need to get into that space as well. So there is definitely an uptick in pace. The world's moving faster, it's changing faster, and that is being both push and pull from the technical capabilities that come with digitalization.
And then Eric, from a tax perspective, I know that it is becoming more top of mind for many tax groups. But generally speaking, what is your view of where the tax groups within different companies are in terms of their view of digitalization and the role that tax is playing?
I'd echo what Ben said. I mean, I think that tax begins with the commercial reality that this is now a focus and it is happening. The pace of change is has increased significantly, and as you know, Moise, tax takes a long time for tax regimes and tax administration to catch up to changes in the commercial world, right? In some respects, tax and tax administration is still catching up to the internet economy, right? We're still stuck in 1997. So I think that the pace of change in digitalization, and especially as data fits into that puzzle, is something that tax groups are aware is there, but there isn't a well-developed body of framework or analytical tools or risk assessment tools to address the tax challenges presented by digitalization.
Right. I think that's one of the lessons we've learned as part of the service line as well, is that there are various functions within companies that are almost operating independently. So I think to that end, one of the areas we've seen that brings the companies together in terms of cross-functional areas is the risk element, because there are many risks that could materialize if companies either don't have a strategy or do some missteps in implementation of their digital strategy. So maybe Ben, you can talk to us a little bit about what are some of the legal risks that could materialize or could occur as companies look to implement digitalization and a business model this centered around digitalization.
Yeah, as ever, risk and opportunity tend to be sort of two sides of the same coin. So some of the things I'm going to talk about now are risks, and some of them actually are potential opportunities for businesses. But I think there are five core legal areas that should be on people's radar screen right now. And there'll be some others for specific industries, specific businesses, but as a general rule across most businesses, these 5 will be true. The first of those is around data protection. So so it's trite to say that data is the new oil, but it's true that lots of the advantages of digitization and increasingly machine learning that comes across the top of that come from the ability to access and use an ever increasing volume of data. And the legal systems around the world regulate to differing degrees what you can do with that data, what the compliance mechanisms are, and including things like cross-border transfers of that data between countries or between regions. And that data compliance piece is increasingly a high-stakes legal issue, in particular in the European Union and the UK, where the fines attached to it are potentially very large, but we're seeing that proliferate around the world as well, the sort of high fine environment for data protection breaches. So that connects to legal structuring around how you manage your data, how you govern it. The second area that I would highlight is around the alignment of those data structures with the tax and operational structures that businesses put in place. And so I'll give you one example of this, but there are others. In my world as a technology lawyer, I'm concerned typically for who the data controller is when it comes to a business's corporate personal data or PII that it holds. That's the entity that makes the decisions in relation to how that data is used, and that typically is where the legal obligations, or the primary legal obligations, attach. And so that is going to be, in regulatory filings, in litigation, is the entity we're going to say is the owner and controller of that data. Now, if your tax structure has the value in that data building up in a different entity, then you have a disconnect between those two structures. Similarly, around the operational side, if in fact what you're saying is the entity that has the value or makes those decisions is not in fact the one that is doing it, you create risk and exposure for your business. The third area, and in fact, the third and fourth, I just bundle these together. I think there is an increasing understanding that part of legal risk management is involved with the governance structures you put around your data ethics and also your AI ethics or your machine learning ethics. So as you digitize a business, your business is going to want to use more tools that crunch big data, but also use machine learning or other forms of artificial intelligence. There is a need to have a sophisticated governance structure, and that will increasingly become a legislative and regulatory requirement. At the moment, it tends to not be a legal requirement yet in most places, but we're seeing a definite trend towards that. And then the final one I'd put on the table is IP rights. And the explosion in interest in NFTs, non-fungible tokens, right now is a good sort of use case for this particular one. I think there's a real question around, as you digitize, if you go into things like NFTs, what is it that you actually own? What's the value? How do you protect that value in a world where the digital ability to transact in something may not match to the legal structure and indeed the tax structure that attaches to it as well? So a range of issues, a range of possible structures and responses to those issues, but certainly ones I would have on any checklist that I was looking to work with.
Yeah, thanks, Ben. You mentioned tax a little bit, but I would like to ask Eric. I mean, tax is obviously focused a lot on data now. As you mentioned, at the beginning, tax often comes in towards the end or towards the back end when something is shown to be profitable and is creating value. But how are different governments and tax authorities really approaching the taxation of data specifically, but also the profits that data is clearly generating for companies?
I'd say that in some respects, the OECD Pillar 1, Pillar 2 solution is indirectly and as somewhat of a blunt instrument, finding a way to, at least in the underlying assumptions and policies behind Pillar 1, Pillar 2, finding a way to tax that value, right? It's a very blunt instrument and it's indirect and it's imprecise, but I think the idea is that if a remote seller is deriving profit from, transactions with local users, then that data is contributing to the value and that data should be taxed locally, or that value should be taxed locally. More fundamentally, so that's pillar one, pillar two, but more fundamentally, international tax systems and country specific tax regimes have not addressed some very fundamental questions about data. Ben mentioned data transfers and controllers, but from a tax perspective, it isn't even clear if that transfer of data should be treated as at least analogous to a transaction in property or rights in property, like an IP transfer, or whether it's a service. Is the developing algorithms and collecting data, is that a service that's provided to external customers or to internal group members? And as you know, if tax doesn't address the fundamental questions of the character of the income and the underlying nature of the transaction, that is it a property or is it a service, the tax answers are very unclear. So I think that tax groups and tax authorities are still struggling with these very fundamental questions about the character of the income and then the source of the income. It matters if we're talking about true external transactions in data, transfers of data, or making data available to third parties as a commercial matter, right? Versus data as a contributor to the overall value chain of the internal enterprise, in which case it becomes something of a transfer pricing question. But even there, the law is very underdeveloped as to how to treat that contribution to the value chain that is data. Is the valuable thing developing the algorithm, or is the valuable thing the data, or is it both? And how do you address the transfer pricing consequences of that?
It's interesting because I think that from the legal side of things, I would say both definitely. Almost in every scenario where you're talking about why those transactions occur, either internal or external. And it's really interesting the point you're making about what is the nature of data in particular from a tax perspective, because I think that is also an area that's evolving in the law. If you had asked me this question 5 years ago, and there's still plenty of people who say you can't have property in data, the reality is that the regulatory regimes are starting to change that, in my view, because they are giving indicia of control towards data, and indeed obligations to control access to and control and use of data on organizations. And once you start putting fences, legal fences around intangibles, then you start to get into a world where there is something to trade. And then you also then see that reflected in the transactional documents in M&A and those sorts of things as well. What are you buying? What's the value generated in this business that you're buying? So I do think we're not far from a world where you'll start seeing courts in major jurisdictions ruling that there are some aspects of property rights for some actors in a supply chain or in an ecosystem in data, broadly spoken. So, I do think this is an area of continuing flux also on the sort of base level law as well.
I couldn't agree more. By and large, taxpayers would prefer to have services transactions rather than property transactions, or especially intangible property transactions. Once you have intangibles, we begin to talk about things like gross basis royalty withholding, or we begin to talk about goodwill accruing in a business. So property is, generally something that taxpayers would prefer to stay away from in favor of finding a services transaction. But I completely agree with you that the right to control access, right, and to transfer something, even if it isn't property in the formal legal sense, begins to sound like the functional equivalent of property for purposes of the tax analysis. I completely agree.
Thank you both for that discussion. I think that's been very helpful. I think the topic that I want to conclude with for this conversation is really, we talked a lot about the importance of looking at risks, and some of these risks go across multiple disciplines, right? We talked about tax, data privacy, regulatory, etc. Just maybe both of you, and maybe I'll start with Ben first. Give a sense for why is this so important for companies to form, like a team, so to speak, that's cross-functional, dealing with the digitalization and dealing with the risks. And a second part of that question is, what is the typically the first step that the company should take in terms of implementing any kind of solution or strategy in dealing with these types of risks.
Yeah, it's interesting. So my one of my roles at Baker McKenzie is the firm's chief innovation officer, and in that role, I spend a lot of time looking at organizational theory about change and disruption in not only our own business but in industry more generally. And a common repeat theme amongst the people who study this area is you can only deal with disruptive change with a cross-functional and an ecosystem approach. You need to operate outside of your individual silos, be that internally, tax, compliance, legal, sales, operations, whatever it is, but also externally in the industry. That's just the nature of the problems that need to be solved are too fluid and too agile and changing too frequently in order to tackle them in the way that industry has traditionally approached those things and organizations have approached those things. So that is why I think you see a need across a range of topics, and this is one of them, to respond to challenges and to respond to disruption through a variety of different perspectives with a team approach. So we are seeing a lot more behavior by clients where you join up the tax, the IP, the legal, the structural side of their business, looking at this challenge to say, well, how do we tackle this as a team approach? And I think that is only logical. If you don't do that, what you have is a series of very, very well-intentioned and very logical siloed approaches to topics, which lead to potential lack of alignment, which is one of the risk vectors that I identified that play out here. So I am a big advocate of that joined up approach. When it comes to what would I prioritize if it was me, I think structure is the first. Have a strategy and have that conversation around structure. Sometimes the objectives you're trying to achieve across those various teams are actually inconsistent. But highlighting where those are and the compromises that have to be made, or indeed the fudges that have to be made, is going to be important to understanding your risk profile. And then the second one I would put up there is governance. Having a structure and a governance structure to take the decisions made in that first piece and make sure the business operates to those and implements those going forward is going to be key. And then finally, agility. The pace of change, as we've talked about, is rapid and only increasing. You're going to have to revisit some of these decisions, probably on a more frequent cycle than was previously the case.
Eric, any other thoughts on that in terms of getting? I know we've talked a lot about, especially getting tax to the table in these conversations, but any other thoughts from your perspective?
Not really, just kind of the tax perspective on what Ben just said, which is spot on and an excellent summary. I think tax is just another one of those potential silos that isn't aligned and doesn't have the consistent narrative. And as Moise, from a transfer pricing perspective, for me, from a planning perspective, it's critical that the narrative you develop for your transfer pricing documentation or position or dispute is consistent with the company's business objectives and how the business actually operates and its legal structuring. And same thing from the tax planning side. It's critical for the narrative in our tax planning assessment to line up with the business's actual operations and their objectives and the way they actually do business. So completely agree with everything Ben just said, but tax is another one of those stakeholders and potential silos that needs to be brought into the conversation.
Yeah, and I think that's a good way for us to conclude. I'll just add finally that, as I mentioned before, we have a service line in Baker McKenzie where we work across practice groups, and some of the most value we add is by helping companies to bring various stakeholders together and helping to facilitate such conversations. So again, thank you everyone for listening, and I'd like to thank Ben and Eric for their time and very helpful insight. And stay tuned for the next episode, which should be coming out shortly after this one. So thanks again, everyone.